We're on the brink of major U.S. tax legislation, with the biggest changes we've seen to our tax code for over 30 years. The speed at which Congress has moved is almost unheard of, and virtually unprecedented for change this significant. This pace has been a challenge, but an exciting one to say the least. The primary objective behind the legislation is to drive growth in the U.S., and there are a number of ways Congress has in mind to achieve that, including lower individual, business, and corporate tax rates, with the latter reduced from 35% to 21% beginning January 1st, full expensing of expenditures on new and used capital assets for 5 years, and a broad range of cross-border provisions, including lower rates on foreign profits earned by U.S. companies with a toll charge on their historic earnings, and restrictions on interest expense and a new minimum tax, both designed to protect the U.S. base. For UK businesses investing in the U.S., clearly the lower corporate rate is attractive, but many could see their overall effective rate on U.S. profits stay in the same ballpark due to the broadening of the tax base. And for UK businesses owned by U.S. parented groups, they may see increased pressure to repatriate cash in the short term, with behavioral change in the long run as their U.S. parent comes to grips with the new rules. All of this means that any UK company with a footprint in the U.S., whether by virtue of their shareholders or by virtue of their own businesses, needs to start understanding the impact on their business immediately. The single biggest issue you need to deal with right now is the accounting, where the impact on deferred tax assets and liabilities needs to be considered. And for many of you, this may not be as simple as applying the 21% rate for deferred tax. There's also an urgent need to quantify any tax due under the toll charge provisions for 2017 reporting, and this can be extremely complicated, so you need to start now. Looking forward to 2018, many of the provisions take effect January 1st. Particularly impacted will be those UK companies with US operations who will need to understand in detail not only the interaction between the rate reduction and base partners, but a ton of other new provisions. And finally, it's worth noting that for non-calendar year taxpayers, although many of the provisions may not start until your next fiscal year, the rate reduction should take effect on January 1st, giving you more time to work out the impact. So there's a lot to think about. Please get in touch with me or your usual PwC contact if you'd like to discuss this further. Thanks.